Welcome to the deep dive. Today, we're tackling a real giant, Benjamin Graham's The Intelligent Investor. Many say it's, well, the single best investment book for regular people.
Absolutely. And our mission here for this deep dive is really to unpack the core wisdom in this classic. We want to get why it stayed so relevant for, what, over 70 years?
Yeah.
And more importantly, pull out the key ideas for you, especially if you're young and just starting to think about, your financial future.
Right. We've been digging into the text itself, plus the updated notes and commentary, trying to pull out the absolute must-know stuff, the core message.
Think of it as your guide to the essentials. So, where do we start? Graham kicks off by defining intelligent investing, and it's probably not what first comes to mind.
Oh, how so? Not about being a math whiz.
Not at all. He actually says intelligence in investing, quote, is a trait more of the character than of the brain.
Character. Huh, that's interesting. So less about raw brain power, more about how you act.
Exactly.
Yeah.
Graham believed an intelligent investor needs patience, discipline. They need to be eager to learn, always. And crucially, they have to control their emotions.
Emotions like fear and greed.
Those are the big ones, yeah.
Yeah.
And also being willing to think for yourself, not just, following the herd.
Okay, that reframes it quite a bit. It's about temperament, self-control. Makes sense. Now, he draws a really sharp line early on, doesn't he? Between investing and speculating. Why is that distinction so vital?
Because honestly, mixing them up is one of the quickest ways to lose money. Graham's definition is pretty precise. An investment operation is one that, after thorough analysis,
Thorough analysis. Okay.
promises safety of principal and a satisfactory return. If it doesn't meet both those criteria, it's speculation, period.
Safety of principal and a satisfactory return. Got it. It's a speculation that doesn't have that guaranteed safety. Is there an analogy, maybe?
Yeah, think of Wall Street maybe like a huge casino.
Hmm.
When you're speculating, chasing hot tips, trading constantly, trying to get rich quick, you're often playing games where the house...
The brokers, the market makers.
Exactly. They have the edge. The odds are stacked against you, really. Most people speculating end up losing or, maybe breaking even after all the costs.
They're just making money for their brokers.
Precisely. But Graham says real investing, done his way, is different. It's like finding a corner of that casino where the rules actually work for you. If you stick to his principles, he argues it's, well, incredibly hard to lose your initial investment over the long haul.
And you should get that satisfactory return.
Right. Speculators make money for Wall Street. Investors build wealth for themselves. That's the key difference.
Okay, but what if you, feel that urge, want to take a flyer on something exciting, a bit of speculation?
Graham was realistic. He knew people would. He basically said, okay, if you want to speculate, fine. But do it with your eyes wide open. Understand you'll probably lose.
Treat it like entertainment money.
Exactly. Like going to Vegas. Keep that money completely separate from your real investments. Only risk what you can genuinely afford to lose without wrecking your future. You need to learn that the hard way, actually.
Well up, yeah.
Yeah, early in his career, 1919, he bought into this hot new thing, Savold Tire. Stock shot up 250% on day one. Huge excitement.
Wow.
By October, worthless. Total fraud. It taught him that raw enthusiasm without solid analysis almost invariably leads to disaster. That's his quote.
Ouch. Yeah, that's a tough lesson. Okay, so if speculating is often a losing game, how does Graham's approach value investing actually stack the odds in your favor? This brings us to margin of safety, right?
That's the heart of it. The core idea is almost embarrassingly simple. Buy cheap and sell dear. Find something valuable, pay less than it's truly worth, and then hopefully sell it later for more.
Sounds easy enough when you say it like that.
Huh.
But how do you know what something is really worth? The cheap part.
That's the million-dollar question, isn't it? It leads to the concept of intrinsic value. Graham's idea was that every company has a kind of fundamental underlying worth.
Based on its actual business, like assets, earnings.
Yeah, assets, earning power, future prospects, even management quality. Think of it like the real value of a local pizza shop based on its ovens, its location, how many pizzas it sells. That intrinsic value is often totally different from the stock price bouncing around on the market day to day.
Right, the market price is just what people are willing to pay right now, which can be driven by anything, news, rumors, moods.
Exactly. It's emotional sometimes.
Yeah.
And that difference, that gap between the often crazy market price and the more stable, calculated intrinsic value, that is where Graham finds the margin of safety.
Margin of safety. I've heard it compared to like building a bridge.
It's a perfect analogy, yeah. Engineers don't build a bridge to hold just the maximum expected load. They build it way stronger, maybe to hold 5 times that load.
Just in case.
Right. That extra capacity is the margin of safety. In investing, it's the cushion between the intrinsic value you estimate for a stock and the price you actually pay.
So if you figure a stock is worth, say, $100 a share based on the business, and you can buy it for $60.
So the $40 difference, that's your margin of safety. It protects you if your analysis was a bit off, or if the company hits a rug patch, or if the whole market tanks. It's a buffer against bad luck or mistakes.
And Graham found some pretty extreme examples of this back in the day, didn't he?
He really did. One of his classic strategies was looking for companies trading for less than their net working capital.
Networking capital, that's like cash, inventory, receivables, minus current debts.
Minus all debts,
Yeah.
even long-term ones. So you're looking at easily sellable assets minus everything the company owes, if the stock price was less than that number.
Wait, you could buy the company for less than its easily liquidated assets after paying off all its debts.
Yeah, which meant you were essentially getting the factories, the brand name, the buildings, the land,
Yeah.
all that stuff for free, or even less than free.
That seems incredible.
It was. He said even in 1957, not exactly a market bottom, he found about 150 stocks like that on the main exchanges. Now, finding those specific nets, as they're called, is much harder today.
Okay.
But the principle lives on. The modern idea might be seeking 60-cent dollars, buying a company whose stock trades at, say, 60% or less of what you calculate its real underlying value is. It's still about finding that significant discount.
That deep margin of safety. And a lot of the time, these opportunities pop up because of Mr. Market.
Ah, yes, Mr. Market. This is maybe Graham's most brilliant psychological tool for investors. He asks you to imagine you have a business partner, Mr. Market,
Okay.
and this partner is, well, a bit manic depressive. Every single day, he comes to you and offers to either buy your share of the business or sell you his share.
Based on his mood that day.
Completely. Some days he's wildly optimistic, thinking everything's amazing, and he'll offer you a ridiculously high price for your stake.
And other days.
Other days, he's utterly terrified, convinced the sky is falling, and he'll offer to sell you his share for peanuts, practically giving it away.
So what does the intelligent investor do with this erratic partner?
You are under zero obligation to trade with him. His moods are his problem. Your job is simply to listen to his daily offer and decide if it makes sense for you, based on your own analysis of the business's actual worth, its intrinsic value.
So if he's depressed and offering a bargain price,
Maybe you buy more. If he's euphoric and offering a crazy high price.
maybe you sell.
Or maybe you just ignore him completely if his price doesn't seem attractive either way. His mood swings create opportunities for you, but you don't have to act on them.
So checking stock prices constantly on your phone, that's just listening to Mr. Market's daily shouting.
Pretty much. Graham actually said investors would sometimes be better off if his stocks had no market quotation at all. Watching the daily ticks just causes mental anguish, he said. You end up reacting to other people's irrational judgments instead of focusing on how the actual business you own a piece of is doing.
That's a really powerful idea, especially today with instant everything. Takes real discipline to tune out Mr. Market. Okay, so for someone young, just starting, maybe feeling a bit overwhelmed, what are some practical defensive first steps Graham suggests?
Yeah, he definitely advises starting on the defensive side. He suggested focusing on large, prominent companies.
Yeah.
Well-established firms with a long history of paying dividends, solid financial footing.
Conservative finances.
Right. He even had a guideline, like for industrial companies, look for ones where the book value, basically assets minus liabilities for common stock, was at least half the total value of the company's stocks and bonds. Just a measure of solidity.
Okay, big stable companies. What else? Any specific techniques?
Dollar cost averaging. This one's incredibly simple but really powerful, especially when you're starting out.
How does that work?
You just invest a fixed amount of money, maybe $50, maybe $100, whatever fits your budget at regular intervals, say every month or every time you get paid. You do it automatically, regardless of what the market's doing.
And the benefit is?
It takes the emotion and timing guesswork out of it. When prices are low, your fixed dollar amount automatically buys more shares. When prices are high, it buys fewer shares.
Ah, so over time, your average cost per share tends to be lower than if you try to jump in and out.
Exactly. It smooths out the bumps and helps ensure you're buying systematically, not based on fear or excitement. And you can usually set it up to happen automatically with a broker or fund company.
That sounds like a great low-stress way to start. Now, what about what to buy using dollar cost averaging if picking individual stocks feels daunting?
Index funds are often the perfect answer there. These are mutual funds or ETFs that just hold a huge basket of stocks designed to mirror a broad market index.
Like the S&P 500, which is the biggest 500 U.S. companies.
Right, or even a total stock market index that holds thousands of companies. By buying one index fund, you essentially own a tiny piece of the entire market, or a very large chunk of it.
So you're not betting on finding the next Amazon, you're just betting on the overall economy growing over time.
Precisely. You're admitting that picking individual winners consistently is incredibly hard, maybe impossible for most people. The commentary added to Graham's book basically says index funds are likely the single best choice for most individual investors, especially if you have a long time horizon, like 25 or 30 years or more.
And buying an index fund automatically gives you another key benefit, Graham stressed: diversification.
Oh, absolutely critical. Holding lots of different investments, not just one or two stocks, is crucial. It drastically reduces the risk that any single company failing will wipe you out.
Spreading your bets.
Exactly. But it's also about making sure you capture the winners. Because history shows that most of the market's long-term gains actually come from a surprisingly small number of superstar stocks.
And you can't know which ones those will be in advance.
Pretty much impossible to predict reliably. The commentary uses examples like Southwest Airlines or Dollar General. Maybe not the companies you'd first think of, but they generated massive returns over decades. By owning a diversified index fund, you ensure you have a stake in those unexpected big winners, wherever they come from.
Okay, so start with stable companies. Use dollar cost averaging, diversify widely, maybe with index funds. What if someone does want professional help, an advisor?
Graham was really firm on this. If you hire an advisor, you are still responsible for checking them out thoroughly. You must investigate their track record, understand how they get paid. Are they earning commissions for selling you stuff, or are they paid a flat fee?
Make sure their interests align with yours.
Yes, and ensure their philosophy aligns with yours. Are they focused on sound investment, or are they pushing speculative ideas? Don't just hand over your money and trust blindly. Choosing your advisor is a critical investment decision in itself.
That's really important advice. Okay, we've got the core principles, the defensive strategy. Graham read this a while ago, but you mentioned pitfalls. Are his warnings about what not to do still relevant today?
Oh, absolutely. Maybe even more so. One of his biggest warnings was about letting enthusiasm get the better of you, that Savold tire disaster he experienced.
Yeah.
He saw that same pattern repeat over and over. Enthusiasm, he said, almost invariably leads to disaster on Wall Street. We saw a massive example during the dot-com bubble in the late 90s, early 2000s.
Right, people just piling into anything with .com in the name, even if they had no profits, no real business plan.
Exactly. The commentary points out internet-focused funds losing 80–90% of their value. People got totally swept up in the idea of the internet revolution, the obvious prospects for physical growth, as Graham put it.
But that growth didn't automatically mean profits for investors. Why not?
Because if the growth story is so obvious that everyone believes it, the price of the stock gets bid up to insane levels. The price starts reflecting not just the expected future growth, but maybe wildly optimistic versions of that growth. All the potential profit for you as an investor gets priced out before you even buy it.
So you're paying tomorrow's price today.
Or maybe the price from 10 years in the future. Graham saw this with Texas Instruments back in the 60s. Its stock price went up something like 20 times faster than its actual profits did. The price just detached from reality.
And then when reality bites back.
The fall can be brutal. The commentary connects this to what happened with giants like Microsoft and Cisco after the dot-com peak. Their stocks fell massively, over 50%, even 75%, even though the companies themselves were still strong. Their prices had just gotten way ahead of themselves.
So Graham's advice was often to look at the unpopular companies.
Sometimes, yes. The relatively unpopular large company, he wrote, might be a much better bet because its price hasn't been inflated by hype and unrealistic expectations. There's potentially more margin of safety there.
Okay, so avoid the crowd-chasing hot growth stories. What other kinds of hyper tricks did he warn about?
Stock splits. He thought the excitement around them was totally irrational. Think about it.
Yeah.
Having two $50 shares instead of one $100 share doesn't make the company worth anymore.
It's the same pizza, just cut into more slices.
Exactly. Yet, companies announce splits, and often the stock price jumps just on the news. The commentary mentions a company called Exodus, whose stock soared just because it announced splits, saying it treats investors like dolts.
Huh. Okay, so watch out for purely cosmetic stuff. What about digging into the actual company financials?
Crucial. Graham warned against falling for just the surface story or, emotional imagery. The commentary gives this great contrast. Cisco, the tech darling of the future, versus Cisco, the food distributor, selling succotash.
Right.
People felt Cisco was more valuable because it seems more exciting. But the intelligent investor has to look past the image, dig into the numbers. Are the reported earnings real? Watch out for things labeled non-recurring charges that somehow keep recurring.
Sneaky accounting.
Can be. Or just understanding how different choices, like how they account for inventory, FIFO versus LIFO, or depreciate assets, can make profits look better or worse, even if the underlying business hasn't changed much. Graham saw companies try to bundle losses into one big special charge to make ongoing operations look cleaner.
So you really do need to, read the footnotes sometimes.
Or at least be aware these games can be played. And speaking of things to be wary of, Graham had absolutely no time for complex mathematical models in investing or for market forecasts.
No complex math. But isn't finance full of formulas?
For Graham's core value investing, he said reliable calculations use simple arithmetic. If you see people bringing out calculus or higher algebra to justify an investment, he called that a warning signal. It might mean they're substituting fancy theory for real-world experience, or maybe just trying to make speculation seem scientific.
Interesting. And market forecasts, trying to predict the next move.
Forget it, basically. Graham thought trying to time the market predicting short-term ups and downs was futile, even for something seemingly more predictable like bonds. The commentary points out that even Alan Greenspan, head of the Fed, gave a super bullish forecast right before a major crash.
So even the experts get it wrong.
Consistently. Relying on forecasts is a recipe for getting whipsawed by Mr. Market's mood swings. Stick to valuing businesses.
Okay, simple math, ignore forecasts, scrutinize the numbers. What about the people actually running the companies? Management.
Hugely important for Graham. He said you want managers who think like owners, people whose incentives align with yours as a shareholder.
How do you figure that out?
Read the proxy statements. Those documents companies send out before shareholder meetings, they tell you how executives are paid if they own significant stock themselves. Are their interests truly aligned with maximizing long-term value for shareholders?
Trying to avoid situations like Enron, Tyco, where management seem to be enriching themselves.
Exactly. The commentary uses those as extreme cautionary tales about conflicts of interest. But even less extreme issues matter. Graham noted how some managers just hoard cash the company doesn't really need for operations instead of returning it to shareholders via dividends.
Or maybe they buy back stock at inflated prices just to prop up the share price.
That can happen too. An intelligent investor pays attention to how management allocates the company's capital, your capital, essentially.
It's really striking how relevant these warnings still feel today, even though he wrote decades ago.
Totally. Graham himself observed that his principles had worked through booms, busts, wars, huge technological changes for almost 60 years by the time he last updated the book. And the commentary makes a strong case they're just as valid now. The market environment changes, technology changes, but human psychology.
The more it changes, the more it's the same thing, as he said.
Precisely. Fear and greed, hype and panic, those seem timeless.
And we have real-world proof that his methods work, right? That appendix in the book, The Super Investors of Graham and Doddsville.
Oh yeah, that's legendary. It profiles several investors, including, famously, a young Warren Buffett and his partner Charlie Munger, who achieved absolutely phenomenal long-term investment results.
And the key was?
They were all following Graham's core principles, specifically focusing intensely on finding businesses trading at a significant discount to their underlying intrinsic value, buying cheap.
And, counterintuitively perhaps, they achieve these better results with less risk. How does buying cheap reduce risk?
It comes back to that margin of safety. Buffett uses this fantastic example from 1973 involving the Washington Post Company. He calculated its assets were worth, conservatively, at least $400 million.
Okay.
But the stock market, in a gloomy period, was valuing the entire company at only $80 million.
Wow. So you could buy $400 million worth of assets for $80 million. Yeah, that feels much less risky than paying $400 million for it.
Exactly. It's common sense, right? But traditional finance metrics at the time, like beta, which just measures past price volatility, might have said Washington Post was riskier because its price had fallen.
That seems backwards.
Graham and Buffett thought it was Alice in Wonderland logic. True risk, they argued, comes from paying too much for an asset. Buying a solid business at a massive discount is the definition of reducing risk. That discount is your protection.
That Washington Post story really drives home the power of that margin of safety concept. Okay, so let's try and wrap this all up. Being an intelligent investor, in Graham's view, it's not about having a crystal ball or a supercomputer brain.
Not at all. It's fundamentally about character, developing patience, discipline, emotional resilience. It's about clarity, knowing the difference between investing based on value and just gambling on price moves.
It's about demanding that margin of safety, always trying to buy things for meaningfully less than they're worth, using simple, effective tools like dollar cost averaging and diversification.
Right. And it's about managing your relationship with Mr. Market, using his moods as opportunities, not letting them dictate your actions or feelings. It means doing your homework, looking past the hype, avoiding obvious traps like overpriced growth stories or accounting tricks.
And these aren't just, quaint ideas from the past. They form a coherent, practical framework that you can use starting today to approach building wealth seriously, to navigate the noise, and make informed choices.
Absolutely. It's a timeless toolkit for sound investing.
So, maybe a final thought to leave everyone with. Considering all the noise, the hype, the crazy swings we still see in markets today, perhaps the most truly intelligent thing you can do is consciously cultivate that patience Graham talked about. Practice thinking independently. Focus on understanding what a business is actually worth rather than just getting swept along by the daily headlines and Mr. Market's drama. So here's a question for you. What's one small step you could take this week? Just one, to be a little more patient, a little more independent in how you think about money or investing.